Hi, I'm Byron Udell, founder and CEO of AccuQuote. Today, I want to share a secret with you. Life insurance companies are praying that you don't learn about a little-known but painfully obvious secret of how to win the game of life insurance. The fact is, most people lose the game, and the life insurance companies need to keep it this way. Now, I'm going to share the secret with you. It's not about how much you pay or what kind you buy or who you buy it from. And if you're thinking the secret only works with certain types of life insurance, that's also not the case. The secret can work with term insurance, whole life, universal life, or any other kind of life insurance. So why would I share the secret with you even if you don't buy your policy from me? Well, I'm actually hoping that once you know the secret, like hundreds of thousands of other folks who have trusted us to handle their life insurance, that you'll do the same. So let's get right to it. You're probably wondering what I mean when I say win the game of life insurance. It means the consumer, you, comes out ahead and the life insurance company doesn't. In other words, you, as the policyholder, ends up making money when it's all said and done instead of losing it. And if you use the secret exactly like I outline it, the life insurance company will lose money on your policy. Now, about the secret. The secret to winning the game of life insurance is actually very easy if you know how. And it's going to sound simple and obvious. It can be summarized in just 6 words. Here it is. Die with your policy in force. I'm going to say it again. Die with your policy in force. Sounds easy, right? The odds of death, in case you don't know, are 1 out of 1. So why do so many people not win the game? Why do so many people lose the game of life insurance? We all die, so obviously it's not because they don't die. They lose because their policy lapses before they die. Now, this can happen for a myriad of reasons. Sometimes it's because they no longer want the policy. Maybe they're divorced or they bought it for someone they no longer care about, so they intentionally drop the policy. Sometimes it's because they run across tough times. They lose their job and have some difficult decisions to make, like, should I feed my kids or pay this life insurance bill? Now, obviously that's an easy decision. If I only had the money for one or the other, I'm feeding my kids. Another reason why policies may lapse is that people move and forget to tell the insurance company they moved, so the premium notice never gets to them and the people just forget about it. A few years later, they realize they haven't paid the life insurance bill in years, and they call in wondering why they didn't get a bill. In the end, the policy has lapsed, and they're stuck having to start over. The bottom line with all of these situations and other lapses is that the insurance company doesn't care why they lapsed. They've collected premiums for years and never end up having to pay a claim on that policy. In other words, they've won and you lost. For example, let's say you buy a 20-year term policy at age 40. Your premium is $892 a year. Now at age 60, the premium goes from $892 to $26,000 annually, and it goes up every year thereafter. And that's a real example. I'm not making this up on the fly. What do you do when you get that ridiculous renewal premium notice? Of course you drop the policy. Who would pay such a ridiculous premium? Let's look at another example. You buy a guaranteed universal life policy at age 45 with an annual premium of $8,000 with all the best intentions. At age 55, since maybe your wife left you and your kids are all grown up, you don't want to keep paying the premiums, so you drop it. The life insurance company keeps your 80 grand and you get nothing. These are real scenarios, and these are classic examples of how people lose the game of life insurance every single day. And the profits the life insurance companies make on all these lapsed and expired policies actually subsidize the ridiculously high rates of return for the people smart enough to continue to own their policies and die with the policies in force. Now, I said earlier that the secret can work with term insurance, universal life, or any other kind of life insurance. Of course, from the examples I just gave you, you can see that you can also lose the game with any kind of life insurance. Now, here at AccuQuote, we've sold hundreds of thousands of term policies because they're simple and inexpensive. So how do you win the game of life insurance using a term policy? Well, you can do it, but you'd have to do something you might not want to do. You have to die before you're supposed to. And dying young is not exactly ideal, at least not in my mind. What about permanent insurance? It costs more than term, but it does have a level guaranteed premium for the rest of your life. So what's the rate of return on a permanent policy at death at life expectancy? Well, that depends on when you buy it, what your health is, and when you die. But let's do the math on a couple of typical examples. For example, I bought a policy last year on myself, age 55, $1 million of coverage at a price of just over $10,000 a year. Assuming I live to age 85, I will have made 31 payments of around $10,000 for a total of $310,000. My family will receive $1 million tax-free for a gain of $690,000. That's an after-tax rate of return of over 7%, and the pre-tax equivalent rate of return, at least for me, is well over 11%. And it's a conservative, fully guaranteed contract issued by a multi-billion-dollar A-plus rated financial institution that's been around for well over 100 years. And remember, that high rate of return is if I die when I'm supposed to. If I die early, then what I have is almost like a winning lottery ticket, except it's all tax-free. The returns are astronomically high. When I bought my policy, I also tried to fathom a scenario under which I could live long enough to make a bad deal out of it. The fact is, I can't. Even if I live to age 100, I still win the game. Let's look at another example, one that's a little more representative of our average customer. Age 43, female, $500,000 policy, lifetime guaranteed premium of $2,500. Say she lives to age 86. She will have paid $2,500 times 43 years for a total of $107,500. Again, at her death, her family will receive $500,000, tax-free, for a net gain of $392,500. The after-tax internal rate of return on that is over 7%. The pre-tax equivalent is again in the 10 or 11% range, depending on your tax bracket. So I have to ask you, in today's world of zero interest, where else can you go and get returns this high without taking market risks? Some people ask me, how can the life insurance company make any money on a policy where they're returning a 7% rate of return if you die at your life expectancy and an astronomical rate of return if you die early, especially when they're only earning roughly 5 to 6% on the premiums you're paying? In case you weren't listening, they don't make money on those policies. Again, if you die with your policy in force, the insurance company will lose money on it. It's the people who buy and drop their policies prior to dying that subsidize the returns for those who are smart enough to die with their policy in force. Look at it like this. The losers pay the winners, and the house, the insurance company, takes a small cut. I know it sounds crazy, but it really is that simple. Here's the bottom line. To win the game of life insurance, you have to own a policy that you'll be able to keep in force until you die. Now, for most of us, that means a policy with an affordable, predictable, and level premium for life. Here's another question I get asked a lot. Why do so many wealthy people buy large amounts of life insurance when they clearly, or at least ostensibly, don't need it? The answer is simple. Wealthy people are usually pretty good at math. They've crunched the numbers and figured out that if they just make sure to hold on to their policy until they die, the rate of return on their premiums at death will be higher than any other safe, conservative investment they could make. In fact, it will likely beat some of the more risky investments without having to take the risk. To them, it's just another asset class. Let's face it, every investment advisor or money manager on the planet always recommends diversification. In short, that means not putting all your eggs in one basket. In putting together a successful financial plan for the future, the experts say you need to make regular contributions to the plan. You should own some stocks, but not all one stock. And you should not just own stocks, but you should own some bonds too, and perhaps some real estate, precious metals, maybe even some cash. And if it's all done perfectly, given enough time to bake, theoretically, by mixing it all up, the returns should be steadier, and given enough time, all should be fine in the long run. But what if you die before it has time to bake? What if you die before your time? No one expects it to happen, and we don't want to think about it, but it happens to people every day. Time, then, is a key component to the success of the plan. Your portfolio is theoretically diversified to protect against a whole raft of risks, many of which will never come to pass. But remember, death is a risk, but unlike the other risks, death is a certainty. Doesn't it make sense to diversify your portfolio against a possibility that you might die early? I call this time diversification. The fact is, if you die young, there is simply no asset class that can come close to outperforming a life insurance policy. And if you die when you're supposed to, around your life expectancy, the rate of return is still around 6 to 8% after tax, which is an 8 to 11% pre-tax equivalent. That beats virtually every other safe investment on the planet. So that begs the question, should you consider taking a small slice of your portfolio and diversifying it into life insurance? Now that's up to you, but I know I did. At AccuQuote, life insurance is what we do. We live, eat, breathe, and sleep life insurance. I've been on the radio for over 2 decades talking about how important life insurance is, and I'm regularly called upon by the media, including the Wall Street Journal, USA Today, CNBC, the New York Times, and Kiplinger's Magazine to comment on life insurance industry issues. I'm passionate about helping every single person I can protect their family with what I believe is the most important product mankind ever invented, with the possible exception of the wheel, of course, and that's life insurance. If you think that sounds crazy, or you think I'm kidding or exaggerating, I'm not. This stuff is that important. I sometimes wonder what people did before it was invented. Now, the choice is yours. If you're going to own life insurance, you're either going to win the game or you're going to lose the game. We want our clients to win. We tell you how to win and give you simple and easy ways to make that happen. As always, it'll be up to you as to whether you decide to take our advice. Thanks for listening, and feel free to reach out to us if you have any questions. You can call us anytime, toll free, at 800-442-9899.